we have a lot of fun stuff to cover here. How to trade interest rate spreads. Katie, I feel bad because you and I talk about spreads and pairs and interest rates and all this different, very interesting stuff, but kind of high level how-to stuff whenever you jump on Wednesdays. But that's because you're the best. You're tops when it comes to mechanics of futures trading, and you've thrown around a knob or two or a tut or two in your day, haven't you?
I have. It's been a couple moons, but again, we're here to talk about this is such a common theme in US news headlines right now, right? How many rate hikes are going to happen in 2022? What is the Fed projecting? What are all the other financial institutions projecting for changes in interest rates over X amount of time? And as somebody that might be new, it's really hard to kind of figure out how you can capitalize or trade on something like that potential opportunity. And so it's a timely conversation to have because I don't think it's going to go away anytime soon. We know that the Fed meets on a regular basis, and therefore we have planned binary events that we can utilize in our trades for short-term occurrences, as well as use these spreads to actually extend duration. So we can play short-term and long-term in the interest rate space. And hopefully this conversation today will actually take out some of the mystery of hikes and rates and steepeners and all the different spreads that you're talking about and make it into a way that is a little bit more digestible for somebody that might be a little green to this area of trading and this particular asset class.
You raised such a great point because I was here, 5 or so years ago where like interest rates, it's one of those things that most people out there, even like some of the most active traders who are trading around S&P futures and options and all this different stuff, interest rates are this asset class where the gravity of it. Like, it's huge and it's important. And you even read about what the Fed is doing. And you can kind of get there. But so many people, myself included, until a couple of years ago, you get lost at like the practical side of it, like where it's like, okay, I can kind of understand, rates going lower. That means that they're trying to incite economic growth. Maybe there's some turbulence, and so they're lowering rates. Oh, rates going higher. That means things are probably good, and they're trying to contract a little bit more from the Federal Reserve. But then when you get into the trading world, it's kind of, you lose it a little bit. It's been hard to take that practical approach to something that is very important. And I feel like we've done a pretty decent job so far, and we're going to hammer home several strategies for you to not only kind of read about interest rates or feel that gravity of this asset class, but take action in it. And to start, you can just look at the performance of the yield markets and tie that into what you've been hearing and seeing on the news. A lot of people at the Federal Reserve specifically talking about how they're projected to hike rates in the next 12 months. Here, now that we're in 2022, they're thinking of hiking 2, 3, 4 times. And you've seen S2Y, which is the short-term interest rate product, by and large, the benchmark for short-term interest rates, which is what the Fed directly touches. Those have been popping off, up huge, Katie, off of that news. And right out the gate, before we even get into spreads, if you think they're going to hike, then you can buy that S2Y. It's already up, what would equate to about 3 hikes. And so you have to kind of, am I getting value? Do I think it's going to be 4 or 5 hikes? That's the conversation. But also from the simplest standpoint, you can sell those hikes with that product as well. Just buying and selling before we get into spreads. That is just as simple as where you think rates are going.
Yeah, and I agree. I think this to me took out so much confusion that I had as a beginner trader. And when I say this, I mean these products, because when you're first learning and you're using the benchmark, like major products, I should say, to kind of learn about interest rates, you soon discover that there's actually an inverse relationship to those major contracts and yields. But here, you're just taking out that relationship in general, and you're just trading the actual yields themselves. So it's like one less thing you kind of have to think about when you're structuring what you actually want to happen. And that's why, yeah, to your point, you can absolutely just trade these outright rather than making them a spread if you do have a general assumption on one of these, sets of contracts from a price perspective alone.
Absolutely right. And so, yeah, the simplest thing if you are getting started in interest rates would be to I think interest rates are going higher. I can buy the S2Y. That's, like I say, largely driven by what the Fed is thinking of doing in the short term. The 10Y and the 30Y, same exact underlying market, just a difference of duration. It's all just the US Treasuries yield, but it's what it is in the 2-year duration, in the 10-year duration, in the 30-year duration. And you can see that the 2-year has outperformed the rest of them. And that's when we get into our conversation for today, because this market is thankfully now very straightforward to buy or sell, whether you think interest rates are moving higher or lower, but very ripe with spread opportunities. You look at S&Ps versus NASDAQ, Katie, or NASDAQ versus Russell, a lot of these equity spreads that I think a lot of people are becoming more acquainted with and are trading back and forth, myself included, those can be tough because a lot of those indices just have different stocks. And I actually had a viewer email me today and just be like, I'm looking at some of those markets, NASDAQ versus Russell. And he's like, those trend in different directions over the last several years. And I'm like, yeah, they present good short-term trades a lot of the times, but over the course of years, sometimes you'll see just technology stocks outperform these different sectors. And so not a lot of reversion there. With something like the interest rate market, some of the best reversion you've seen in spreads, starting with the TUT. It's flattened a good amount. It's down to its lows. But as you can see with historical data here, it's a market that kind of trades around the same levels and is now just down to its lows.
Yeah, and just to recap for everybody out there, the TUT, I mean, you have it displayed here, but that stands for the tens under twos, under tens.
It's funny that the vowel it kind of changes between U and O. It's like this under that or that over that. But yeah, it's essentially twos to tens, right?
Right.
And
yeah,
so
I mean, and here, yeah, go ahead.
So what you have here is how I usually display it, and I think how people do display it a lot of times, which is the longer duration minus the shorter duration. And so what you have on that y-axis, Katie, is just the difference between S10Y, now priced at around $17, which is 170 basis points or 1.7%. And you have subtracted from that the 2-year, which right now is priced around $900 or 90 basis points or 0.9%, however you want to think about it. And you can see that y-axis is just that 17 minus that 9, and it's times the 100 multiplier for all of the products. And so that gives you the notional difference, which is just around $900. And that's all, fine and dandy to kind of sift out structurally what all that means. But conceptually, you see that the yield curve has flattened to a very heavy degree this year, Katie. And we can talk about what that means. But first, I just want to highlight that it's the same for the knob spread, which is notes over bonds, which is the 30-year minus the 10-year downward sloping price action here, which is called flattening, which just means yields are coming together, right?
Right, exactly. And the math still applies. So you would take that 30-year, subtract the 10-year from it. That's right around 300. And that is exactly what we're showing here on this graphic as well, just to help people that might not be able to, chart this in the way that they want to or whatever, but still get an understanding of, where they are in the curve. Simple subtraction is an easy way to utilize this with the small exchange products to get a feel for whether or not, like you said, we're flattening or we're steepening.
And what's really nice is you almost don't need to chart some of these to know whether they're at an extreme to the downside or extreme to the upside. Now, all of these spreads are right now at an extreme to the downside, as you can see. And now I even roped in the tub spread, which we don't talk about very often, but that's the 30-year minus the 2-year. But going back to this example here, you can see at just $3 of difference between the 30-year and the 10-year, Katie, which equates to 30 basis points, just 0.3% between the 30-year yield and the 10-year yield. If that gets down to zero and they're the same price, that's what's called completely flat. And that would mean that those yields, those two different durations, one longer than the other, and the longer duration almost always having a higher yield than shorter durations, that would be flat. If the 10-year has a higher price than the 30-year, that's what's called an inversion. And hopefully a lot of you out there, that was kind of like a light bulb moment. It's like, oh, I know what a yield curve inversion is. And it's as simple as Katie just being like, oh yeah, S30Y is at $21. If the S10Y is at $21.50 or $22, that's an inversion. And I didn't even need to chart it, right?
Exactly. And that, again, should signal there's even more opportunity when it comes to spreads in these products.
Absolutely. Because we very rarely have an inverted yield curve. I think I've looked at it before, and it's like less than a percentage of the time going back the last several decades is a part of the curve like this inverted. And that's why we look at these opportunities to potentially buy these spreads at their lows, because we've seen great mean reversion in this asset class. And because now it's very simple with these products and also cheap with these products. It's only going to cost you to trade each of them individually a couple $100. So pitting them against each other is still, I think we can get this one done for under $1,000 when we're looking at what's called a yield curve steepener. The market has flattened, and now we're looking for it to steepen, those yields to kind of separate. And it's as simple as buying the long term, selling the short term. In this case, we're looking at buying the S30Y and selling the S2Y, and you can get on the other side of that extreme.
Exactly. So this is doing an actual steepener with the quote tub spread. And what was the chart of that? That was closer to like 1,200 in difference. Perfect. So what you're hoping to happen here is obviously we're going to pop back above that 1,200-ish level to, again, steepen with this particular setup. And the good thing that I like about this too is, like, I mean, we're talking about this and we're talking about interest rates. And of course we know that there's headlines around interest rates all the time, but we tend to see more activity around FOMC meetings. I believe the next FOMC meeting is later in the month. But the cool thing about doing these and talking about these today is we can still put this on today and like not have to think about this as such a total binary event where you have to put it on like the 24th or the 25th of January in order to get like the best location. Like you can put this on today and, you know, keep it on for a couple of weeks, depending on your profit and loss targets and depending on the movement in here, and not have it be so focused on just this one single event in a couple weeks.
Totally right. And there's 2 points that I think kind of hit on that exactly. One being, these markets are so interesting and so many eyes are on them and they're so efficient that prior to that FOMC meeting, a lot of the spreads and everything is shifting, even though the Fed hasn't come out and said anything quite yet. They're so good at kind of modeling these things and predicting it going into the event. So yeah, any given day, whether it's an FOMC meeting or not, a good day to take a look at this stuff, and you could get better prices than when the FOMC occurs. But also, this is something I feel a lot more comfortable with holding through some of those events as well, because it is a hedged up spread trade. If the Fed comes out and says, oh, we're never hiking, or we're going to hike a ton, interest rates are going to either fall a lot or rise a lot. But this spread is these two pieces working against each other here, Katie. And so I've got a more hedged kind of risk managed situation with something like the tub spread. And we don't have enough time, but we're going to get to this maybe in the coming weeks. The most hedged variation of this, putting all three parts of the curve together, essentially putting on a tut spread and a knob spread, maybe being short one S2Y, long two S10Ys, and short one S30Y. We'll take a look at this another time, but I just wanted to give people a little tease, a little sneak peek to how crazy you can go in these interest rate spread markets, because it's just so many permutations of interesting new opportunities in this world. But I think we covered enough here today. What do you think?
I agree. And I just want to say the last thing too is if you did want to put that trade on the S2Y and the 30-year, it's like $550 in buying power if you're doing the 1-to-1 ratio. So really digestible when you compare it to like an actual knob spread, which I'm sure is probably upwards of at least 8 grand. I haven't looked recently at the margin requirements for the knob spread with the outright major contracts, but this brings it down to a much more digestible level for somebody that's, like you said, new to trading, or maybe doesn't have a lot of capital to work with, but still wants to participate in this market that, like you said, has been super interesting and super engaging in the last couple of weeks.
All right. That's fantastic. Fantastic point there. Cause yeah, you're exactly right. I mean, I don't even remember putting on those knobs. It'd be 3 ZNs, 1 ZB, Katie, and it would be a price tag of at least 5 grand. So great point there. I'll bring it up in the platform here in a second, but we do need to get out of here because do you hear that? Shh. The fireman. It's splash. Oh. It's splash into futures. I was gonna do a fireman coming kind of thing vis-a-vis the Lil Wayne conversation. Everybody go listen to Fireman and also listen to Katie on all the shows that she's on and her on Twitter, Katie McGarrigle. She is a fantastic Twitter follow, fantastic person, and we're always so happy to have her on Small Stakes once a week on Wednesdays. Thanks so much, Katie, and everybody. Thanks for watching. Splash into Futures coming up next.